This week, my guests are Abebe Selassie from the International Monetary Fund and global finance expert Frannie Léautier. What really causes debt distress in many African countries? What steps should governments take to make economic progress, create jobs and social safety nets? We'll also look at what it all means for you and your pocket. Straight Talk Africa starts now. Hello there and welcome to Straight Talk Africa, coming to you from VOA's headquarters in Washington. I'm Haydé Adams. A warm welcome to the show. 2023 has been a difficult year for economies throughout Africa. Global political and economic headwinds could make the road ahead even harder. That's the view of the International Monetary Fund. This week, my guests and I discuss the current economic landscape of countries in Sub-Saharan Africa. Let's begin with my conversation with Frannie Léautier. She's the CEO of SouthBridge Investments. We talked about the benefits of diversified economies and how it can help countries to cope with external shocks and unexpected world events, as well as the current crippling debt crisis. I want to look at countries with high debt. When we look at the list of countries in the world with the highest national debt, about 8 or 9 of them are in the West. The United States topping that list. Japan is there. There are several European countries that are on that list. And then if you look down that list, developing countries are far lower down on the list. So what then makes debt a crisis in Africa, for example, as opposed to Europe or North America?
It's very nice to be here. Thank you, Haydé. First, because most developing countries have debt that is taken in US dollars, and therefore when there's any impact on the exchange rate, the cost of servicing that debt goes up. Therefore, debt distress in a country that borrows in foreign currency, especially when its own currency reduces in value, becomes a bigger burden to repay the loans. And that's one reason why countries that have high debt, that are poor, and that are dependent on foreign debt for their development become more risky than, for example, the United States, which borrows in dollars and repays in dollars. So there are no currency effects on debt in countries like the United States. Second, it's because of the capacity to actually generate economic growth and have sufficient revenues to repay or service the debt. Because these are countries that are still in development, therefore they need a lot of spending for infrastructure, for education, for health. And those are quite pricey and heavy investments. So when you are in high debt distress and when your debt bill gets very high, you have to trade off between repaying or servicing the debt or continuing to build infrastructure, provide social services, and even meet the basic salaries of civil servants and so on. So this is a second reason why a debt crisis becomes a development crisis, because it has immediate social effects. And then the third reason is that it makes the cost of borrowing even higher, because then the rating agencies that rate a country with high debt as high risk, and that makes the cost of borrowing even higher, and that therefore even borrowing in the future gets impacted, and so you get straddled with heavy debts to repay every month with increasing cost of servicing the debt, and then even higher cost of borrowing. It's like if you buy a house, for example, and instead of paying in dollars, let's say you buy it in euros, you borrow from Europe. And when the US dollar versus the euro changes in value, with the euro becoming much cheaper, the dollar becoming much cheaper, then the cost of paying your mortgage will immediately go up. And if you try then to refinance or to try to buy a car with more debt, the cost of buying a car would even be higher, because the banks will look at you, see you have a large mortgage left to pay, and they will price the loan much higher for you. So you can't afford then to have both the house and the car, and you may have to make trade-offs. So it's the same thing with countries.
You spoke about now, some internal pressures and external pressures. Can you talk to us a little bit more about the really internal threats or risks inside a country, and then the external factors that could take a country with high debt into debt distress and ultimately cause a debt crisis?
Mm-hmm. So many developing countries are first very vulnerable to external shocks. If you take the example of climate risks, a flood, look at the floods in South Africa that destroyed a lot of value. They had an impact on the rand. They had an impact on people's lives. People lost their lives, but also lost their property, and that created a huge cost to rebuild and bring back the value that was lost. So that's the first shock that hits very badly developing countries, because they don't have sufficient resources to recover after crisis. And this is why, for example, countries like Barbados, through their prime minister, have worked so hard to get the multilateral development banks to have special clauses that suspend debt repayment during catastrophes like a cyclone or so on, so that the countries can recover and then start repaying their debt. The second external shock would be things like oil prices and currency risks because of the movements in the financial markets, and those all make it more expensive than, for instance, for countries that import oil. It becomes more expensive for those who import food and fertilizer and medication and so on, and that overall raises the cost of day-to-day life. So that's the second sort of external factor that can impact on countries. Internally, it's things like political stability, including, for example, now in Africa we see there are several coups that have taken place that causes huge risks at the country level. And what is unique then about Africa is that it doesn't only impact the country that's had a coup. Overall, you can see there's a risk premium on the whole continent, because the rating agencies take a look at the trends and they anticipate that this may happen elsewhere, so the prices go up for almost everybody, including the countries that are stable and that are performing well. So that's an internal risk that can become an external risk for countries.
If you just happen to be in a dicey neighborhood regionally, that what happens next door, never mind if you're practicing good fiscal policy, that could affect your how investors see you as a potential risk.
Absolutely. In fact, that's you use the term bad neighborhood. You can be the best performing in that neighborhood, but you'd still have the effects of the risks of the neighboring countries. So that's one important factor that starts off as internal, but then because of regional economics and regional ratings, it impacts the neighboring countries as well. The third internal factor could be the structure of the economy. For example, economies that are highly dependent on agriculture, which is most of the African economies, like 60% of more of the GDP is dependent on agriculture. If there's a risk, whether there's a drought or a disease or locusts or any kind of risk on the sector, it immediately brings down the entire economy. And this dependency on single sectors can be a major risk for countries. It also happens for countries that, for example, are reliant on one major export, like diamonds or gold or oil. Exactly. You can see, for instance, how Nigeria used to be impacted tremendously by the oil prices until they diversified their economy. So that internal risk is quite high. And then finally, there are other factors, for example, the degree to which your society is educated, how strong the social safety nets are. For example, for many years in Africa, the social safety net was this family. If you retired, you got sick, or you grow old, your community and family would take care of you. Nowadays, you are in between for those who are mostly in the cities, and the insurance mechanisms and social protection hasn't kicked in. So you find this very vulnerable group of people who don't have either community protection or insurance and social protection, and they become very vulnerable. And that vulnerability translates more broadly into economic factors as well.
According to the IMF, Africa is home to 8 of the world's least diversified economies. Some countries have not managed to move away from a single high-value commodity as their primary source of export revenue, such as oil or diamonds, for example. Others have made significant progress. Experts say when a country diversifies its economy, it builds resilience and protection against external shocks like wars, global economic downturns and pandemics. I asked Léautier how African countries have fared in their efforts to diversify their economies.
I think a lot has changed. If you take the example of Botswana, even though they remain dependent to a large extent on major exports like the diamond industry, they have actually invested in internal transformation of the diamonds, so they do more polishing and cutting, and that brings added value to the economy, even though they're still dependent on the single export. So that's one way in which countries that were dependent on single exports have diversified by going deeper and deeper into transformation. This happens also with agriculture, where agricultural products are now packaged and transformed and preserved, so that the dependency on the single product is less risky, for instance, when something happens weather-wise or in other factors, because you can preserve and therefore have available for the future. But the third big factor has been regional trade. With the continental free trade area, this has given a huge opportunity because countries can now trade with each other. And we saw that during COVID. During COVID, the exports from Tanzania into Kenya grew by 30%. And that was a huge boost to the Tanzanian economy, even though it didn't change the structure of its production. So the near neighbor trading, which is now made possible because of the international free trade area, the continental free trade area, is helping Africa diversify at least in its dependency on single products. And then the rest of it is just a straightforward traditional diversification. Countries like Nigeria are less vulnerable today because they've invested heavily in manufacturing, they've boosted their agricultural sector, they're less dependent on the oil economy than they were before. They created funds, some of the countries put together funds, sovereign wealth funds, that take the boost in revenues, for example, now that the oil prices are high and they get windfall revenues, and they put them in these sovereign wealth funds that invest in future development. And that also helps to soften, if you like, the dependency on single large sectors. And maybe the best examples are countries like Kenya that don't have major dependency on a single type of product or export, that are really diversified quite widely. And maybe the only risk factor now is the tourism industry, which then gets impacted by security risks, by COVID, as we have seen, and by war. Otherwise, they are very, very diversified.
And speaking of war, we are now in a worse place than we were about a year ago, when we thought this one war was already one war too many. We obviously have still conflicts, war in Sudan, etc. And now we seem to have to be in yet another war. How has that affected African countries, or are those impacts that are yet to come?
Well, at the moment, the countries are still reacting and responding to the effects of the Ukraine war. So that is still working its way through the economy, and countries are quite resilient, but nevertheless being impacted, mostly in the cost of fertilizers, because of highly dependent on imports from Ukraine, wheat and other agricultural products, agricultural machinery. So the agricultural sector and the food sector were very highly impacted. With the current war in the Middle East, there are similar effects, but it will probably take a little bit more time. It depends on how long it's going to last. But the type of effects would generally be, for example, if it would impact the financial markets, which would make the interest rates higher for Africa, and the currencies are already quite devalued. And so the combined effect of the currency devaluation and high interest will be a very serious effect. It could also have an impact on things like technology, because Israel and Africa have been working very closely in the past few years with technology transfer, particularly in the agricultural sector. And this type of technology is very relevant for more arid zones in Africa. So that is going to hurt because the exports will slow down if the economy in Israel is then turned to finance the war, for example, which may have an impact on the tech transfer sector. Of course, other effects, because about 30 African countries have embassies now in Tel Aviv and Jerusalem. So diplomatic travel and things like that may be impacted. Lots of tourists go to the Middle East, both to Israel but also to Saudi Arabia and the other countries, and they may stay home, and that may have effects on that as well. But I think at the moment it's a question of how long it's going to last for those effects to materialize.
Well, now, in the final part of our conversation, Léautier and I talked about the debt crisis in some African countries. South Africa's Institute for Security Studies says public debt on the continent has surged dramatically in the last 10 years to a staggering $1.8 trillion by 2022. That's up 183% since 2010. Over the last 20 years, China has become the continent's largest creditor, bankrolling major infrastructure projects across Africa. Western nations have long accused China of pushing African countries into a debt trap, by a claim that Beijing rejects. I asked Léautier to help us understand China's role in some of the debt crises we see on the African continent.
So when Africa borrowed from China mostly to invest in infrastructure, and that was at a time when there were very few other opportunities to get financing for infrastructure. So those loans were financed sometimes by securitizing them against mineral exports or other collateral. And those then became impacted, for example, when the prices of those mineral products were impacted by global factors, it made that debt costly. Secondly, it was quite heavy because these are infrastructure investments which do tend to require a lot of heavy investment. Then more recently, Africa has borrowed from other countries as well, including from multilateral development banks. And right now I think the African Development Bank is the largest lender to infrastructure in Africa. So it has displaced China in terms of the size of the investments in the sector. Secondly, China has actually renegotiated debt with a number of countries, including countries like Ethiopia, where there was also a deal that China participated in for Zambia, because Zambia was in high distress, and that was a very important deal brokered by the US and other countries, and China participated. So I think the impact of Chinese investment in Africa is much less now in terms of a burden than it was a number of years ago. And then finally, now leadership in Africa is much wiser in terms of negotiating good deals when they go shopping around for financing. And the fact that you have China, India, the United States, Russia and other countries all giving offers for financing allows Africa to pick and choose and negotiate better terms. That's why I was very happy to see the announcement that was made just before the US-Africa Summit in Botswana, that the United States is going to increase its contribution to Africa's development. And today, the United States is the single largest bilateral aid donor, for instance, to countries like Tanzania. However, it's number 15 when it comes to trade. So I think the big gap now is to address the trade issue, because most countries in Africa, when they export or import, are exporting and importing to China, because China is number 1 or number 2 on the list of most African countries in terms of the destination and origin of exports and imports.
And that was Frannie Léautier, CEO of SouthBridge Investments, speaking to me recently here in Washington. We're going to take a short break here, and when Straight Talk Africa returns, my conversation with Abebe Selassie from the International Monetary Fund. We're going to take a closer look at Sub-Saharan Africa's regional economic outlook. Stay with us.
In times of change, when the world seems uncertain and what we hear doesn't reflect what we see, we seek the truth. When we are told only part of the story, we lose trust. In moments of crisis, our dreams, hopes, and wishes for a better tomorrow depends on a free press. At Voice of America, we bring you the stories that people take risks to see. We connect the world and unite it with truth. At Voice of America, we show you the whole picture.
Sextortion is the abuse of power to obtain a sexual benefit, according to a study done by Harvard University. It can manifest itself in various forms, including demanding sex in exchange for grade. This unsavory practice is used against female students in Nigeria, Botswana, Tanzania, and it's been used to exploit women seeking employment in South Africa. This week on Our Voices, we are discussing the sextortion of women in Africa. Join the conversation each week right here on Our Voices.
You're watching VOA's Red Carpet. My name is Jackson Vunganyi. Thank you so much for joining us each week right here on Red Carpet. We bring you the latest in You're with Straight Talk Africa. Welcome back. The last 3 to 4 years have been brutal on our people. That's the word from the International Monetary Fund's Abebe Selassie. He heads the IMF's African department. He was referring to the economic impact of global events on African countries, from the COVID-19 pandemic to food and fuel shortages, as well as sky-high inflation. The knock-on effects sent many African economies reeling, but there could be a light at the end of the tunnel. I interviewed Selassie recently. Here's what he said.
I think I would highlight two factors. I think the first is, of course, the lingering effects of the pandemic, particularly on the public finances. It has had a really, really big impact. Governments basically, countries saw their economies being hit very, very hard as a result of the pandemic, with associated impact on tax revenues, overall economic activity, and that, of course, has burdened public balances, causing debt to go up and some difficulties around that. I think so. The lingering effect of the pandemic has been affecting many of our countries, and that also we've been seeing in 2023. And this has been amplified or made worse by, of course, recent challenges in accessing capital markets, the surge in inflation, commodity prices. All of these have made economic conditions very difficult for people in the region, and that's why we highlight how difficult 2023 has been. Now, that said, we do see through the course of 23 activity beginning to accelerate. So going forward, we expect growth to continue picking up in Sub-Saharan Africa.
You warn countries in your report against prematurely relaxing what you call stabilization policies. Can you give us some idea of what these stabilization policies are and what would make countries want to perhaps relax them too soon?
We were flagging two areas in particular. First is we've seen inflation accelerate, as you noted earlier, as a result of higher commodity prices, particularly for food and fuel, and of course also just the cost of borrowing has gone up. We think that in the first instance, it's really, really important to make sure that inflation stabilizes and continues to trend downwards. A premature easing of monetary policy conditions can lead to inflation either being stuck at a higher level or accelerating going ahead. And this, of course, inflation is extremely detrimental for people, particularly the most vulnerable, who have fixed incomes and are not able to shield themselves against inflationary pressures. So it really is very regressive tax on the poor. I think this is an effort that has to be sustained for quite a bit. We've seen fiscal deficits stabilizing and even beginning to narrow. And I think this needs to be sustained for a little while further to make sure that, in those cases where debt vulnerabilities are quite high, and coupled with the liquidity squeeze that we're seeing, these liquidity challenges don't turn into solvency challenges. So staying the course for a bit more, I think, will be very important for our policymaking in the region.
Can you give us some more insight into what your report means for the pocketbooks of ordinary citizens in African countries? I know not all economies are equal, but what should people generally expect to feel in the short to medium term? Only more inflation woes, only economic pain?
I have to say that the last 3-4 years have been really quite brutal for our people. I think we were saved from the worst health consequences of the pandemic, but the economic toll on our countries has been really very difficult. I think it's a period where we've seen poverty levels, of course, go up, and even worse is the fact that we've seen a lot of scarring. The key thing that we've been doing with the region, of course, is first and foremost stepping in to provide financing. We've done so like never before. Just since March 2020, we've provided financing to the tune of about $60 billion for Sub-Saharan African countries. And all of this, of course, is to help countries counter a lot of the effects that the pandemic. I think we've been working with policymakers to try and make sure that spending is being targeted to support the most vulnerable households in the region. It's also beginning to work on making countries more resilient so that going forward, our countries, people will be less impacted by exogenous shocks. And this, of course, has required some difficult measures by country authorities. One example is, of course, needing to mobilize more tax revenues. Again, we work to make sure that these revenues are mobilized in a way that is progressive, that is impacting poorer people less than and making those that are able to pay more companies, households that can afford and can pay more.
Just finally, some African countries have, of course, made headlines for the fact that they are in some serious debt distress, and for years now. From what you have seen in recent months, are there any sort of standout examples of countries that have had some success with, their efforts towards debt restructuring? And if so, any ideas about what they're doing well?
As I mentioned earlier, the impact that these a cocktail of shocks, really brutal shocks, have had on our economies includes, of course, the increase in debt vulnerabilities in the region. Debt level across the board really has gone up. And in some countries, it has resulted in debt becoming unsustainable. So I'm here talking about countries like Ghana, Zambia, Chad earlier on. Debt has become sustainable. And so we've been working with country authorities to make sure that in those cases where debt is clearly unsustainable, it is restructured so that the burden of repaying unsustainable debt doesn't fall on the poorest. First, Chad was able to restructure its debt and bring debt to a sustainable level. So that has happened, and they've taken important steps forward. And more recently, we've seen a lot of progress being made by countries like Zambia and even Ghana. And what I mean by progress is that the time it's been taking for debt to be restructured has been shortening over the last couple of years.
And that was Abebe Selassie, head of the International Monetary Fund's African Department. Thank you so much to all my guests, and thank you for always watching and for always listening. And I'll see you next time. Goodbye.